Although companies must follow accounting standards, companies make numerous choices and decisions within what is allowed by those standards. In general, accounting choices related to long-lived assets affect the timing of expense recognition, which in turn affects companies' profitability for the current period and trends in profitability in future periods. Choices resulting in lower profits for the current period, such as expensing rather than capitalizing expenditures, generally result in higher profits in subsequent periods, and thus a more favorable trend. The choices may impact cash flows through taxes. When WorldCom revealed on June 25, 2002 that it had uncovered a $3.8 billion accounting fraud, everyone from smallest investor to President George W. Bush reacted with shock and outrage. How was this possible? How could such an established company have hidden such a huge expense from investing public? So what exactly did WorldCom do? During 2001 and the first quarter of 2002, the company counted as a capital investment of $3.8 billion that it should have spent on everyday expenses. This video discusses the implication for financial statements of capitalizing versus expensing costs in period in which they are incurred and in future periods. In the period of the expenditure, an expenditure that is capitalized increases the amount of assets on the balance sheet and appears as an investing cash outflow on the statement of cash flows. In subsequent periods, a company allocates the capitalized amount over the asset's useful life as depreciation expense. This expense reduces net income on the income statement and reduces the value of asset on the balance sheet. Depreciation is a non-cash expense and therefore, apart from its effect on taxable income and taxes payable, have no impact on cash flow statement. In the section of statement of cash flows that reconciles net income to operating cash flows, depreciation expense is added back to the net income. Alternatively, an expenditure that is expensed reduces net income by after-tax amount of the expenditure in the period it is made. No asset is recorded on the balance sheet and thus no depreciation occurs in subsequent periods. The lower amount of net income is reflected in lower retained earnings on the balance sheet. An expenditure that is expensed appears as an operating cash flow in the period it is made. There is no effect on financial statements of the subsequent periods. Now let's look at an example that illustrates the impact on the financial statements of capitalizing versus expensing an expenditure. Assume two identical companies, Cap and Now, start with 1,000 euros cash and 1,000 euros in common stock. Each year, the companies recognize total revenue of 1,500 euros cash and make cash expenditures of 500 euros. At the beginning of the operations, each company pays 900 euros to purchase a computer. Cap estimates the computer will have a useful life of 3 years and an estimated salvage value of 0 euros at the end of the 3-year period. Now estimates a much shorter useful life and expenses the computer immediately. The companies have no other assets and make no other asset purchases during the 3-year period. Assume the companies pay no dividends, earn 0 interest on cash balance, have a tax rate of 30%, and use the same accounting methods for financial and tax purposes. In essence, the two companies are identical but differ in their accounting for computer purchase at the start of the year 1. Now let's see how we will solve this problem. The left side of Exhibit 1 shows Cap's income statement, that is, with the expenditure capitalized and depreciated at 300 euros per year based on the straight line method of depreciation. How did we get to 300 euros for depreciation? Well, we take the cost of computer, which is 900 euros, minus salvage value, which is 0 in this case, and then divide the result by useful life of the computer, which is 3 years. This gives us 300 euros per year as depreciation expense. Now the right hand side of the exhibit shows Now's income statement, with the entire 900 euros expenditure treated as expense in the first year. Based on the first year's number, it can be concluded that Cap Inc. is 7 times more profitable than Now Inc. Now let's look at what happens in future years. Cap continues to claim 300 euros depreciation each year. However, Now do not have any expenses related to their computer purchases in the future years as they expensed it all during year 1. As we can see, in the next 2 years, Now Inc. looks more profitable than Cap Inc. To To calculate the cash flows from operations, we need to add to the net income any non-cash expenses and any adjustment to net working capital. In this simple example, the only adjustment required relates to the depreciation expense, which is only applicable to CAP. So the first year's cash flow from operations for CAP is basically equal to its net income of 490 euros plus depreciation expense of 300 euros, which is 790 euros. Now INC does not have any depreciation expense. So the first year's cash flow for now equals to its net income of 70 euros. Following the same process for the next 2 years, we get CAP INC's cash flow from operations as 490 euros each, and now INC's cash flow from operations as 700 euros each. We can also calculate the total change in cash balance. For CAP, since we capitalize the cost of computer, we'll have cash flow from investing during the first year as we are treating the computer as an asset. This gives us total change in cash of negative 110 euros. For now, we already included cost of computer as an expense during the first year, hence there will not be any cash flow from investing. So the net change in cash for now INC is 70 euros. Following the same process, we find that the net change in cash for CAP INC for the next 2 years is 790 euros each year, while for now INC is 700 euros each year. Note that the sum of net income and total change in cash over the 3-year period is identical whether the asset is capitalized or expensed. It illustrates that although capitalizing results in higher profitability compared to expensing the first year, it results in lower profitability in subsequent years. Conversely, expensing results in lower profitability in the first year but higher profitability in later years, indicating a favorable trend. A newly hired CEO will have a strong motivation to expense everything and blame the poor performance in the first year to the old management. This will result in high profitability in future periods in which he can claim a bigger paycheck. Similarly, a CEO close to retirement will have a strong motivation to capitalize all expenses and boost current period earnings to claim larger compensation. In this video, we saw how a firm can use the accounting principles and boost the current period earning by capitalizing or improving the future earnings trend by expensing. Try to identify any such activity for the firm you're analyzing for your final projects. In the next video, we'll analyze the impact of depreciation methods on current profitability and future earnings trends.